A warm welcome to another Ringside with Perspective, and I'm joined yet again by my co-host Clement Vautrin in France in the sweltering 40 degrees Celsius. I'm joined by Daniel Milan in Canada, a little bit cooler, and me here in South Africa where it's pretty chilly. Alphabet released robust interim results to the end of June. Clement, perhaps starting off, what did you pick up in the fundamentals?
So I would say first that as a general comment, the results were again super impressive. We used to say for those type of companies like Google, Meta, there's a lot of unseen and they tend to surprise us a lot with their quality. And again, so it was not a surprise to be surprised, but we were again surprised by those results. With growth on the top line, also on the earning side, again margin expansion. So that was again super impressive. And also so if I had to pick up a few elements, the few key elements from this set of results, it's really the fact that they again restated the fact that they're gonna re-engineer their cost base, like also said previously Meta. And I think that's important because their essence of their business is really innovation. So that makes sense that it's gonna be an engineered cost base. So I like this statement. Also, it was very interesting to see their comment with regards to the AI and their positioning. They said that they are uniquely positioned, and so I tend to agree with them because they were first mover in that space. Also, they have massive infrastructure already in place in order to respond to the needs of AI itself. They have also, among the peers, they have also the biggest firepower financially to respond to the needs of cash to finance the investments in that space. And also they have some of the best engineers in the world. So that totally makes sense to me, this comment. And I like also the words they use or what they want to emphasize in the AI space. They really talk about how is used their AI for the professionals and for developers, which is different from the vocabulary that use Meta, for instance. So I thought that was something interested also, and also something we were looking at was the performance of the cloud business. So because there was some criticism in the past or dupes about the capacity of Google to perform in that space, and the numbers go in the right way. They are performing exceptionally well with again strong growth on the revenue side, and they are super highly profitable. So no cloud in the sky here.
I think you said the cloud business is already over $10 billion in revenue and over $1 billion in operating profits per year.
Yeah, exactly. So
and that's just a small division within Alphabet, which is just remarkable.
Yeah, that could be a business.
That's incredible. Yeah. But I know one thing that we as a team also pay attention to and that we've picked up in Alphabet, it's got such long-term success and growth, and yet they maintain this operating discipline and this culture of innovation. And it's something that we'd love to see evidenced in the businesses. And there's some of them that reach a certain scale and a certain size and then seem to forget about that completely. And especially in the growth phase, not being able to look at costs in a very disciplined way.
Absolutely. Fighting hubris is the English term for it.
And having clear sight of why you exist as a company, why you started, and you can still see the evidence of that culture coming through from the founders, which is great to see.
Yeah, that's what I think. That's also because, like for Meta, you still have the founder that is around in the business, so that probably strongly help on that side.
Yeah, shifting over to Vicat. Clement, perhaps briefly tell us, what Vicat does and where they operate, and some of the things that you also saw in their interim results, especially in the context of the capacity utilization.
Yeah, so Vicat, so it's a French business that is actually headquartered not so far from where I live. Before they were in Paris, and now they are in a very tiny village close to Lyon, probably to cut costs a little bit more with this very cost-saving, their cost-conscious approach that the family has in running the business. So it's a French business, but they operate globally in the cement space and aggregate. So they have operations in Asia, also in Africa, They are in Brazil also, in the south of the United States, and in France, in Switzerland, and Italy, and also in Turkey and Egypt. So they are really a global business, well diversified. And so that's a 170 years old business. So a very, very old business, and it's still family owned and family run. So it's actually the 8th generation of the family members that are within the
Clement, if
company.
I'm not mistaken, I think they're the world's first organized cement company, isn't it?
They are actually the people that have invented artificial cement in 1817. So that's the first generation of the Vicat family that has invented the artificial cement in France. And then they have built a couple of years after Vicat as a company. Yeah.
Wow.
And sorry, Clement, and then just touch on something similar to what we've seen in PPC. So they've demonstrated good operating, volumes, and it comes through in the accounting as well now.
Yeah.
But are they at full capacity utilization yet?
No, not at all. Actually, so it's different from regions to regions, but in general, at a group level, they are roughly at 70%, 75% of capacity utilization. So there's still room to grow here. And if we look at the different regions, so they run almost at full capacity in the US, close to also in Africa and in Asia. But for Europe and Brazil, the capacity are not at all fully utilized. It's even decreased in Europe due to the weakness of the residential market. So there really still room to grow here. And what has been very impressive in their results, so it's if we just step back 1 year, 2 years ago, with the Ukraine-Russia crisis and the inflation that spiked, the energy prices that spiked up also, they had their cost that more than doubled during the period. So you would imagine that put a lot of pressure on the business, but they actually managed to stay really highly profitable through the cycle, despite also the low capacity utilization. And that was really thanks to the proactivity of the family in the way they increased prices. So that was really impressive. And since then, they have continuously improved the margins and expect to recover to the pre-crisis level. And they are on track to do that. So that was really, really impressive, their performance.
And it's nice. It's nice if a company has that lever or that option. So essentially, they don't have to spend additional capex to generate extra growth. All they have to do is to grow into their capacity that they can produce. And we've seen that in PPC as well, which is perhaps even more underutilized than Vicat is.
Yeah.
Daniel, you've also perhaps you can just touch on the innovation that we've seen at Vicat, different to what we've evidenced at Alphabet, but innovation nonetheless.
Yeah. Oh, we touched on it earlier, in terms of the 170-year-old company and the roots of innovation that they've come from, having basically created the cement industry. And not a surprise, perhaps, but this company is now also the world leader in developing a environmentally friendly cement, which is less carbon intensive. And it's a new product, and it's growing incredibly fast off a low base. But that's very exciting, and it's very important to us that our companies behave responsibly. We want to behave as responsible shareholders, but we definitely demand that our businesses that we invest in are also known for their own corporate responsible behavior. And this is not a tick box ESG exercise. We just citizens on this planet, and we want our companies to do good and stay away from doing bad things. And if they are doing bad things, to stop it or to address it. And so that's very impressive to us with Vicat as well. I think most engineers, if you ask the opinion, it's like, well, there's probably space for another bridge.
Moving on to global markets and portfolio strategy. So for anybody who's been keeping their eyes on the market since Friday last week, it's clear that there's quite a bit of stress in the markets and with market declines across the board. Daniel, perhaps just a word on our portfolios and also our portfolio management strategy in this context.
The markets have been rock and rolling in the last couple of weeks. Since the middle of July, the S&P is down almost 10%. And we've seen some really aggressive moves developing in Asia in particular, and Taiwan and South Korea and Japan. Japanese stock market, they've all dropped 20% very, very quickly. And yesterday, the Japanese stock market dropped. At one point, it was down 12.5%. I mean, this is for a major economy stock market. It's very unusual in my career, I've seen it only on a few occasions where the stock market index of a leading country drops by more than 10% or in a single day. And here, the day after, the Japanese market is up 5-6% again. So the volatility is suddenly extremely high, and it's not unusual. Take a little step back here. We have been talking about this now for years, probably for 4 or 5 years. We've been talking about the levels of speculation globally, the short-termism of market participants, the level of overvaluation of the major indices. This is a complex and dangerous, backdrop contextually. And also, the one extra thing is the heightened geopolitical risks that we see around the world. And it's terribly sad. The wars, whether it's Russia, Ukraine, or what's developed in Gaza is absolutely horrible, the loss of life. And that is now spilling over into potentially a Middle Eastern regional conflict with Israel and Iran, and the US sending additional, military equipment into the Middle East. So this is a dangerous time in the world, and I'm very, very happy that we are all very far from where these conflicts are isolated. But it's not something to ignore. So we've been through, since the Second World War, we've been through quite an extended period of time in the world where there's been not that much conflict at a global scale, or probably none at a global scale, actually. And there's a lot of people in the world that are well armed and spoiling for a fight. And that's not good for stock markets for obvious reasons. Anyways, so also starting 5 years ago, the Investment Council of Perspective, which consists of the 2 portfolio managers, which is Mikhail and myself. We've been talking to you about this and writing to you about this as well, but we've been very deliberate about improving the level of resilience of the portfolios that we build. We want to make sure that we own companies that are producing products and services that is needed daily by their customers. That was one of the key objectives that we set 5 years ago. So if you look through the individual holdings across our entire portfolio, that is exactly what we've gone and done. And whether it's peacetime or wartime, the goods and services are still going to be needed, and that's really important to us. It's an element of resilience in the portfolio. We want to own the best company in every industry that we own.
Globally.
Pardon, Nick?
Globally.
Yes, globally. That's also incredibly important to us. We want a company that is the cost leader, because when the industry gets in trouble, it's the cost leader that can survive. The company with the lowest marginal cost of production is the one that can survive the longest, and that can survive, a wartime, scenario. And we're not predicting a global war. We are saying, if it happens, we want to make sure that we're going to be okay. And that's really important to us. So yeah, we're watching and monitoring these developments with great concern for the loss of life globally, and we hope, of course, that there will be peaceful, resolutions found to these things. But we do not want to be naive about this, and that we want to make sure that your money and your portfolios are going to be okay, even in a worst case scenario. That's incredibly important to us. So one thing we watch very carefully is, how does our portfolio behave when the market gets a little bit shaky like this? So that's very important to us. It's kind of like a little asset test we can go in. And I'm very pleased to say, I know, Clement, you've run some of the numbers for us in the last couple of weeks, but our portfolios are exhibiting a strong degree of resilience. In practical terms, our portfolios are not declining by as much as the indices, and that's very important to us. to stress test the portfolio. We can stress test the portfolio with market conditions, and we do that all the time.
Also, thanks for that, Donnie. It's also nice as a portfolio manager, if you are in a position when the market is essentially losing its head, you can remain calm and keep your eyes firmly focused on what matters, which is the business fundamentals, and then to act in a counter-cyclical way to actually look for opportunities to buy into the best businesses, as you mentioned, globally. And we've put in a lot of effort as a team in preparation for this to identify those businesses. So we know which businesses we want to buy, and we know when they get there that we want to buy them. But we've also got a portfolios full of some of the best businesses globally, because we've already positioned and kind of preempted this, which is a nice position to be in.
Yeah, and it's not by accident. You know, we worked very consciously and deliberately over the last 5 years to set up the portfolios to be ready for this environment.
Okay, moving on to the last topic, which is Bell. The family, or the founding family that still owns 70+% of the company, made a second offer to minorities. Clement and Daniel, we've been doing some broader research into why companies choose to delist. Perhaps unpack that for us.
So Bell Equipment is a business that we've owned now for probably five or 6 years already, and we believed that it was deeply undervalued. We started buying at 10 Rand. It eventually fell all the way to 2.50 Rand, the classic value investors curse during COVID. And as the share price came out the other side of this, the family grabbed an opportunity to buy low. They're very smart business people, and they behaved as can be expected of smart business people, and they tried to buy low, and they offered minorities 10 Rand a share on the basis that it's more than the share price, which of course is, to us, patent nonsense. It's just engineered management speak for grabbing an opportunity. But often institutional shareholders, and particularly individual shareholders, can often fall for this rhetoric. We didn't, and we managed to block the offer. You know, kindly said no, thank you. And the share price.
Sorry, I just wanted to come in there. Coincidentally, during this similar period, a very queued up corporate owner or co-shareholder with Bell was the John Deere Group, and they happened to sell out at this ridiculously low 10 Rand share price.
There's a balance, the interesting distinction of having in the past year earned more in earnings per share than our average cost per share, which is quite an interesting fact. And the share price has been doing quite well and went up to the 30 Rand level or whatever. We hadn't sold any, and then there's been some shifts in the shareholder base, in the minority space, where unfortunately two institutional shareholders cashed out at 20 Rand, and that presented the family with a second opportunity. This time around, they seem to have done their homework a little bit better, and they came back and offered 53 Rand. And you bear in mind, it's only 2 years ago that they thought it was 10 Rand was a fair price. You know, now they've offered 53 Rand, which is equal to the net asset value per share of the company. And we are still of the opinion that Bell Equipment is worth, you know, more than that. So as we say, it ain't over till the fat lady sings. We are in progress right now, so we can't comment on this. But we'll see how things develop. It's probably all going to come to a head in the course of August. But Bell Equipment has been a strong contributor to our fund returns over the last 6 years. We still maintain it's a fabulous business. It's one of the best companies in South Africa, in our view. It's under the radar. Nobody really knows much about this company, but it's family owned, and the Bell family and the other families that are part of the founder group are some of the best business people on the continent. There's no doubt about it. And they know a good deal when they see it. And if they think that they are prepared to pay 53 Rand per share, I think it's a safe bet to say they probably think it's worth a lot more than that.
Absolutely.
And we happen to agree with them. So we have, as minority shareholders, we have certain rights, and we will execute our rights and try and get a fair price out of the family.
Of course, the risk that we want to avoid is to not end up being a minority in an unlisted business, and something that we'll obviously monitor as the process unfolds.
But there's been a bunch of delistings from the JSE over the last 15 years. In fact, when I started in the industry, there was almost 800 listed stocks on the JSE, and now there's less than 300. So that's a very significant change over many years, but it's been escalating of late. And there was an article published on MoneyWeb by someone pointing out a few negatives to being listed. And we felt it was a great opportunity to act in our own unique way and rather go and talk to the business people in our network directly, instead of writing public articles about things we know very little about. So we've been doing an exercise to engage directly with executives of listed and unlisted companies and find out what their frustrations are, directly from the horse's mouth, so to speak. And it's been an incredibly enlightening experience for our whole team.
I would say that it's really with regards to the breadth of and the diversity of the actual benefits or cost and feedbacks we got also. That was quite surprising. And I remember I had a class at school where we set up we listed the different costs and benefits of being listed, but it's actually just what you can actually see. So what is hard in the numbers, but the actual soft aspects, which is maybe what weighs more in the balance. So both on the positive side and the negative side, that's something you don't really think of and nobody really talks about. In the general public. So I would say I was very surprised by that. And I would say that seeing the list of costs, that's understandable why there's probably a lot of delisting that happened, especially for companies that either are ignored in the market and can't actually benefit from the benefits of being listed, and also for companies that don't really need to access, for instance, lower cost of capital, that type of things. So that I would say that there's good reasons why company delist, and I would say that maybe to me the major risk would be really on the loss of quality on the leadership side, because we can see based on our feedback that there's a lot of pain you take as executive of listed businesses due to the fact that you are public, and that people that probably doesn't really understand what you're actually busy doing, or that don't have the same type of view than you, like being short term whereas you think long term. So there's a lot of pain on you, and so I imagine that for people that are quality and that doesn't want to be affected by this type of behavior, I would imagine they can think about shifting to the private market, to entering the private market. So if things continue this way, both on the governance side and on the attitude of shareholders and the public, I imagine there's a risk of decreasing the quality of the leadership in listed businesses, which will end up by decreasing which will end up decreasing the performance of listed businesses themselves. So it's really something to pay attention to, I would say.
What's interesting there, and it's the point that you made to us earlier this week, was that there seems to be a differentiation between being a large listed business and a small listed business. And in a large listed business, because you perhaps have more liquidity and you've got a larger market cap, perhaps it makes more sense because there's more interest. And this can be perpetuated perhaps by the move towards passive as well. And then it might make sense. And then you have this overlay of, do you have a listed game, and can you use your fluctuations in your multiples on your share price to actually do value accretive things? Whereas you're kind of hamstrung as a small business, especially if you've got multi-years, sometimes decades of no one paying attention to your business and not seeing the quality there. And therefore you don't have that lever to pull to actually generate those returns.
Yeah, exactly.
Yeah, 100%. I mean, behind the scenes, we've been engaging with authorities to try on our own side, speaking to serious market participants in South Africa to see if there can be some reason, some common sense being applied to start swinging the pendulum, back a little bit. But it's quite clear. And by the way, the delistings trend is not a South African only thing. We are seeing it all around the world. And we mentioned earlier today, we talked about the proxy voting of Disney and 3M in global companies. And this is the sort of thing that can create, it wastes a lot of resource. It's particularly the most valuable thing is executive time and energy and stress levels. And if you have to deal with this rubbish, then that's by far the biggest cost. As Clement pointed out, the explicit costs are actually by far the smallest part of the cost of being listed. And we do not think it's a good thing for the public markets to shrink too much. There's an element of cyclicality to this as the markets go up and down. But what we are seeing globally is that the listed environment is in structural decline. And the key reason is this nonsense, this whole ESG movement, essentially globally. We're not saying that we in our process, corporate responsibility is critically important, and we do not want to touch any companies that are behaving irresponsibly. But this ESG movement and all the rules and nonsense, it's not going to catch anybody. It didn't catch Steinhoff. It didn't catch Enron. And you can make as many rules as you like, but you'll never catch the bad people. In fact, the bad people can use the rules to circumvent and hide all their nonsense. And we don't like that. And it also removes accountability from the process.
And the catch here, Donnie, is if that, and Clement, is that if you spend 80% of your time ticking boxes and writing super long reports, in excess of 150 pages, then you spend less time running your business in the best possible way. And that's not good for businesses and the respective stakeholders that depend on them.
Yeah, absolutely. No, the executive time to think is just the most underrated thing in the world. And, and it's not just about having time to think, it's also about having your mind freed of stress. And there's nothing more stressful than dealing with ESG for an executive. And in the unlisted space, it's a fraction of the same level of nonsense that they have to deal with. And it's just very important to understand that. The sad news that we have for you is that we do not yet see a lot of common sense out there. So at this stage, it's not a surprise to you, perhaps, if you're in South Africa, in Johannesburg or Cape Town, that most of the new fancy head offices are legal firms. That industry is clearly booming, which is a clear indication, of this pendulum swinging too far in our opinion. So we'll see how this all unfolds.
Thanks, guys. That was insightful. And as always, our work continues.